Being able to borrow money from yourself is awesome. It's one of the biggest benefits of a cash value life insurance policy. But I understand why people think like this. Make it make sense. Throw $20,000 a year into a whole life policy so then you can borrow from your policy to use for other investments like real estate. Ha ha ha. The crap these salespeople come up with is wild. Don't believe it. Yada, yada, yada. He goes on from there. Well, first off, it's not something salespeople came up with. It's something that banks have been doing for generations. They're the biggest holders of life insurance policies on the planet. So just simply, it's not a salesperson thing. It's a banking thing. But here's why it works. You can have your cake and eat it too. If you don't know what that really means, that means that you can finish your cake, eat it all, and still have it. How, right? So with cash value life insurance, you can borrow against your policy to go and buy whatever you want. Here's the benefit you're getting. You're getting to use other people's money, and you're getting to leave your money in your account earning compound interest. It's growing while you're using it. So you're out there spending other people's money because they know you have it in a life insurance policy. Then when you get a return on that money, you start funneling it back into your life insurance policy, either through traditional methods, through your job, if you're making money through your work, or through the generation of income through that asset that you bought or that you invested in. Now that income's coming in, put it back into your life insurance policy. The policy now has much more in it because it continued to grow. Let me give you a quick example. Let's say you have $20,000 in your life insurance policy earning 10% annually, right? So that's $2,000 a year. Let's say you borrow $1,000 from the policy to go and invest it in a new thing that you came across that you want to be a part of, right? $1,000. Insurance companies charging you, let's say 6% interest or 5% interest for that loan. So that $1,000 you're going to have to pay back and pay an additional $60 on top of the $1,000 back into your loan, back into your policy if you decide to do that. Now, so that cost you $60, right? No, it didn't. It actually made you money because your life insurance policy gained 10% from the $20,000 that was in there. So it actually made you $2,000. Let's say you decided to borrow that $1,000 from something else. Where else can you do this? You can go to a bank and apply for a loan. Can you do it with your brokerage account? No. You have to sell your position. So the best way to use your life insurance policy is actually to borrow against it with the intention and the plan of putting